Welcome back, everyone, to the Bitcoin Business Bureau. I'm your host, as always, LitecoinLeader. Okay, today we're talking about banking and how it all works yet again. And I'm going to put up here, where's the branding? Where is the branding? Hello, branding. Hey, there's the logo. Okay, we got that fixed. So up here will appear a link shortly to a video from Mike Maloney. But before I describe that and before I go into all that details, I'm going to try to remember at the top of the video to say, if you like this kind of content, if you like these videos, please like, share, subscribe, hit the notification bell, helps out the channel. Also, share a link to this video if you really like it or find one that you really like. Say, hey, this guy seems to know what he's talking about. I think, check him out. Might help you out, might help me out, might help everybody out. We all look good. Okay. So today's topic is lending. And it's banks. And it's the particular type of lending is called fractional reserve lending. Now, some people will mention that a lot, and that's been the rule for a long time. And The History of Money by Mike Maloney will be the video I put up here. I think episode number 1 and episode number 4 are probably going to be the ones that you want to watch for that. I'll link both of them up there. There's 10 parts to it. So there's lots of good stuff to it, but I think episode 4, where you really get to see how the banks and the Federal Reserve and the money currency really gets created, not money, currency. And episode 1 for this difference between money and currency and how fractional reserve lending you started. And it's really good stuff. So it's a little dry, I understand, but it's important for you to understand how your wealth is kept and who's managing it. And are they looking out for you, or are you looking out for yourself the most? Okay, so we're going to talk about fractional reserve lending. Now, what does that mean? Now, what that means is that you used to be that when banks first started, way back when, okay, gold and silver were heavy to lug around. Okay, so the banks would often make it easier for people by saying, here's your gold. I weigh it. It's 4 ounces. Here's an IOU or 4 IOUs for an ounce each. Come on back when you want, exchange this IOU for your ounce of gold. That's how the banking worked. 2 things happened when that system started. One, the people started to realize that those IOUs were as good as gold. They could exchange them in the marketplace because they're worth. The bank's going to give you an ounce of gold for that piece of paper. So if you want to spend an ounce of gold, here's the piece of paper, or you have to go back, get the gold, and give it back to that person. It's easier to just work with the paper. Because of that, item number 2 happened, which is that the banks started to learn that people don't usually come back for all their assets. So what they started to do is they started to lend more and more beyond what their holdings was. So if they had 1,000 ounces of gold, and let's just say it's $1 million, okay? Rather than loan only $1 million, which is they can cover, they would loan 2 million. Then they loan 3, 4, 5, so on. And to the point where banks started to fail, and then they intervened. And the U.S. government, for example, set rules on how much you can lend and how much reserve you must keep. So if I put $100 into the bank, a bank with a 10% reserve must keep 10 of those $100 on their book, so if I come back and say I want my $10, I can get it. But the other $90 they can lend out, and they lend it out. And so, like, someone comes in after me, gets a loan for $90. They get $90. They walk out of there. They deposit into their account, whatever their bank is. That bank can lend $81 of it, and so on and so on and so on, up to the point where if everybody's at a 10% reserve, you'll have a 10x on the money as in circulation, currency in circulation, not the money, currency in circulation, than originally deposited. So $100 will become $1,000 in the marketplace through loans and banks, and that's what they do. Because they believe there's not going to be a run on the bank. So they trust the faith. So that's fractional reserve lending. Now, what are the fractions? 10% used to be a reasonable number, but they've changed those numbers in the last 5 years a great amount. It's now like 5%, 3%, even some of them don't have reserves. So you can imagine what banks are doing with those kinds of rules. They will lend whatever they want, and they'll just create currency out of thin air. If you want to come in and you can apply for a mortgage and the bank can sell that mortgage to somebody else, alleviate all their risk, they will rate that mortgage for, just say, $500,000. They'll sell it in the marketplace for, say, $400,000. And all of a sudden they've got $400,000 that they created out of nothing. And you have to service the debt and the mortgage to that new bank. That's how that works. So where did that $500,000 come from? It never existed. The banks created it on paper, but electronically, and then they sold that for $400,000 cash or whatever cash equivalent they got, and it puts that note did not exist, but now it has a value, and they sold it. So they got paid for something that didn't exist before based on your credit worthiness and the fact that they could sell your credit and your loan to somebody else. That's what they do. Mortgages, auto loans, everything. Now, will that come back to haunt people later on? Quite possibly. And I'll talk about default swaps in the next video. But I just wanted to get this video out there, talk about fractional reserve lending. Again, Mike does a great job of illustrating it and shows that a society built on debt, which is the American financial system, that is the system that we operate in since 1913 with the Federal Reserve, the dollar bill, and the IRS were all created in one fell swoop in 1913. Imagine how that all happens at once. So banks have a license to literally print money or just create money digitally. Now wait until CBDCs hit the market and more things hit the market, and then banks get even greedier and they try to take even more advantage of the system that they help create. So, but I wanted to explain what fractional reserve lending was. You understand the lending process to begin with, where banks came from with the IOU process, which became dollar bills. And of course, I have one on the floor because I just made another video. 1 and 2, that's about what they're worth. But this Federal Reserve note, you read at the top, Federal Reserve note. This is a debt instrument. So this is owed to somebody by the time it's created. And the banks love that you owe it to someone because that helps them create their wealth because they sell your debts. All right. And then they buy real assets like gold and silver, which the central banks have a lot more than they have ever had in the history of people who have been tracking that, which is a while. Certainly in the last 100 years, I believe this is the most the central banks have had as far as a gold reserve. So they are concerned that there could be a financial reset or some kind of shock to the system, and the currencies could start to lose value or devalue or just go belly up. And then the system, the jig is up, the game is over, and now they have to go back. Well, hard assets, we still have gold, we still have assets, and we're good to go. So they're hedging their bets by holding more gold than cash. They hold very little cash in banks, as you probably have figured out if you've ever gone there and tried to make a withdrawal, say $10,000. They say, well, please schedule an appointment so you can have that cash on hand. They don't have a lot of cash. So lots said today. Hope you understood a little bit more about the fractional reserve lending. If you, again, leave a comment down below. I'd love to read every single one. I'll respond to them all as well. But lots said today. I'm going to close the drawer on the bureau. Say file leader one more time, and I'll talk to you soon. Take care.